Thanks for joining us again this week. This is the Alhambra Investments Weekly Market Pulse. Joe Calhoun is here, and this week we're going to talk about what happened in the first half of the year now that we're into the second half. Joe, your article this week, you talked about contrasts and the way things looked January 1, the way they looked on July 1. I mean, some of the things you talked about, the economy's in full recovery now, asset prices were soaring, S&P and 500's doing better than NASDAQ, a lot of things you put in there. How does all of that fit together? What's your opinion of the first half of the year?
Well, I think people have gotten caught up recently in seeing how things maybe have slowed a bit. They're looking at interest rates and so forth and thinking that things are fading a little bit. But when you look at it in a little bit longer context, we'll put it in a little bit more context and look back to the beginning of the year. Look, we've come a long way in a very short period of time. I was thinking about it, in the beginning of this year, we had not closed on our new house here in South Carolina yet. I was experiencing my first winter in 30 years. There was a lot of things different back then. You couldn't go out to dinner. There was a lot more caution about the virus. And, 6 months later, here we are, and we've added a lot of new jobs, or recovered a lot of jobs, I guess is a better way to put it. The economy has grown. We're just about to surpass the previous peak in this quarter. And so things have changed a lot in that 6 month period. I think people just forget about it. What happened so quickly. I think people just forget about how bad things were just 6 months ago. We were looking forward at the time and thinking things were going to get better, but we're here now. And I just find that really interesting that we lose that perspective sometimes. I think it's good to look back a little bit further and just see how far we've come.
One of the interesting things to me, you said that we are 7 million jobs short of where we were pre-COVID. But it's possible the GDP in the second quarter is going to be about 1% higher than we were. And you've seen a lot of productivity. Is that just because people are producing more on their own? It's because of added technology? Is it a combination of things? What is it?
That's the great question, Bob. I mean, we're back to where we were from an output standpoint, but we're still 7 million jobs, almost 7 million. It's about 6.7 million. Of course, if you factor in the ones that should have been created that weren't, then we're probably 7 million short or even more. But it is interesting that the output has returned, and yet a lot of people are still out of work. I question whether, I think people have this idea that these 7 million people have to go back to work for us to be fully recovered. It's not true, obviously. And I question, too, how many of those 7 million people really want to go back to work? I think there's a lot of things that are changing in this economy because of the virus. And I think that I just read an article from the Riksbank, which is that Norway or Sweden, maybe Sweden's central bank, 220 years of looking back at viruses, previous pandemics and so forth, and what kind of impact they have. Some of the impacts are very short term, and some of them last decades. The way people form households and so forth, what they think about work, how they work. All those things could be changing for the really long term. And it's a productivity surge in a way. It's also a change in the composition of our output, more on the good side, less on the service side a little bit, although that's starting to correct itself. It's just an interesting time from an economic standpoint about how the economy is changing. I don't think anybody would have expected that we'd be short 7 million jobs and be back to where we were from a GDP standpoint. That's a pretty stunning thing, actually. Did we really not need those 7 million people? I don't know. In some ways, maybe we're more productive because people aren't working. It's one of those strange things that we don't think we'll know the answers, the real answers to this conundrum for probably years. It took a long time and a lot of research to figure it out.
Well, I think we've seen a lot more speculation in the first half of 2021. You had a lot more people just jumping into cryptocurrency. You had investment firms that were buying individual residential properties, junk bonds. I mean, you talked about those this week. There's a lot of things we haven't seen to this degree for a while.
Well, speculation is always in markets, I suppose, but the degree is what concerns us. I haven't seen markets like this, speculation in markets like this since 99, 2000. But there was a lot of speculation in housing back in 2006 too. So is it a function of interest rates? I think that's part of it. People don't see any real loss from not having savings or not making anything on it anyway. Take it out of the bank, do something with it. I don't know. I guess I kind of get that. But I would like to see a little more thought go into what the heck people are buying, because they seem to be buying, whatever is the popular thing, whatever's mentioned latest on Twitter is the thing that captures their imagination and gets and attracts the money. Yeah, there's a lot of speculation. Look, I think what that means is that there is a lot of money out there. Now, how that money ends up in people's pockets and what they do with it, as there was this old saying about the Fed, they can create money, but they can't predict where it's going to go. I think this whole debate about inflation and restricting inflation from an official standpoint to goods and services is kind of ridiculous when you think about it. Is there anyone who believes that monetary policy doesn't have an impact on, say, housing prices? Well, of course it does. I just think that there's a lot of things, a lot of reasons why people have money in their pocket and they don't know what to do with it. It's not a ton of money in savings. We came out of the other end of this thing with a ton of savings. It's making nothing sitting in a savings account. So people are speculating with it. It's not going to end well. These things never do. Somebody will lose money. A lot of people will lose money. We don't really get involved in those things, but I see it as a sign of just excess liquidity in the market. Now, the ironic thing about that actually is that the Fed is actually in the process, in a way, of removing liquidity from the market. They seem to recognize the problem, but of course they're creating the problem too through QE. So, they're creating a problem that they're trying to clean up. Why don't they just stop creating the problem to begin with? I think that would probably be a better answer, but that doesn't seem to be on the agenda at the Fed. QE's on autopilot. They just keep doing it. And so now they get this money piled up in the reverse repo facility, because on the one hand, they're buying bonds from the open market and then selling them back to the market via reverse repo, in a sense at a negative price. I mean, they're paying people 5 basis points to take these treasuries off their hands. It's just kind of nuts. If you ever wondered how was QE effective, I think we just got our answer. It's just a big circular flow at this point. It goes in the Fed, it comes out the Fed, and it goes back into the Fed. It's kind of crazy.
I've lost count now how many times QE has not worked. 4,
Yeah,
5,
well,
6, 7, I don't know.
it is ironic that there are people out there who are saying that this reverse repo, if they continue to do it, actually could lead to an illiquidity problem. It's like, I'm not sure that we're even close to that. I think people, if the market goes down 5% or 10%, does that mean we have a lack of liquidity? Well, in some ways it does. But, maybe we need a little less liquidity right now. Maybe that wouldn't be a bad thing. Knock some of the froth out of this market. I don't know. The Fed seems deathly afraid of upsetting stock market or any other market for that matter. So I suspect it's going to continue one way or the other.
Well, let's talk about one last thing today. Is it going to be harder to find the right investments in the second half of 21?
Well, I think that some of these things have gone to so far. I mean, you look at the S&P 500, a Schiller PE of 38 or 39, whatever the number is. It's just a giant number. I suppose that it's possible for earnings to grow fast enough to make these current valuations worthwhile, but I really kind of doubt it. I think that I'll put it this way: if the averages go up a lot from here, I think it's just a multiple expansion. Things getting even more expensive. I'm a little skeptical of that idea, so I think that it may be more tactical in the second half of this year going forward here. I think you're going to have to be a little more choosy. It's not just going to be a matter of being in the market and capturing the beta of the market. You're going to have to find some things that buck the market maybe. We're spending a lot of time on individual stocks and on sectors, looking at sectors that have performed poorly over the last decade, over the last half decade, looking at those as potential places to put new money. Look, we look back at bear markets in the past. There's always some place to kind of hide. Where could you go in 2000, for instance? Well, if you avoided technology, you probably did pretty well. Same thing in 2008. If you avoided financials, you avoided that big wipeout in financials, you probably did a little bit better than the market. So I don't know what those are going to be this time. I have my suspicions, but we'll see how it goes.
I keep hearing this phrase thrown around. This is a whole new world, but the smartest guy who ever lived said there's nothing new under the sun. So in the markets, do you think this is a whole new world?
Yeah, no, nah. People are the same. Listen, markets are made up of people, and people really don't change. I don't care whether you're talking about the 1700s or the 2100s, the 2000s. I mean, it doesn't really matter. Markets are ruled by fear and greed. That has not changed one iota. So, and look, in some ways, it is a brave new world. It's technology that we've never seen before, and I think there's a potential for great things to happen from here with artificial intelligence and some of the things going on in biotech. But people are still people, and so markets will continue to function as they always have. I don't really have any doubt about that. Right now, greed is the dominant emotion in markets, and until that changes, it is what it is. You got to live with it.